Good day, YouTube. My name is Colin. Thanks for tuning in to Financial Success. Today, I'm going to talk about the key differences between casino-style gambling and stock market investing. Alright, so thanks for tuning in. So let's jump into this. The reason I wanted to make this video is people that maybe aren't as experienced and knowledgeable about the stock market, think of it as gambling, or think of it as just playing the stock market, that type of thing. And that's so far from what it actually is. And with just a tiny bit of knowledge of investing and a tiny bit of knowledge of finance, with just understanding a few basic things, you'll clearly start to see where the big distinction is, okay? Now, we'll start off by kind of defining the terms of gambling and defining the terms of how we're going to refer to investing in this video. So gambling, we're talking primarily casino style gambling, or playing the lottery, that type of thing. Games of chance, where typically you're putting money on hoping that a card flips your way, or roulette, you're hoping that your number comes up. Those types of things where you really are not in control and you're just hoping something good happens and you're hoping you get money, and there's really nothing else to it other than you're putting money in and you're hoping that you're making money on it. Conversely, when we talk about investing, there's a whole bunch of good ways to invest, but in an attempt to try to keep this simple, keep this to the point, I'm going to talk about just a standard purchase of an S&P 500 index fund or ETF, like SPY or something like that. All right, so now that we've defined our terms, the first thing I want to point out is the thing is, when you go to a casino, no matter what game you play, the casino is going to have the edge. All right, this is kind of a fundamental thing. A lot of people already know this, but the casino always has an edge no matter what you play, whether it's slots, whether it's roulette, whether it's blackjack, unless you're going to count cards. And even if you're going to count cards, it's difficult to have an edge. And even if you count cards perfectly and you get the count just right and you show up at the table and bet big just when the count is hot, you're still at such a slight edge that it's almost a 50-50 coin toss anyways. So as a total aside from that, you're better off just investing in the stock market than counting cards, because I've tried looking into both of them, and trust me, just buy stocks. It's much safer. It's much better. You're gonna make more money that way anyways. All right, off of that topic. So gambling, you're going in, you're just buying, you're playing games. Investing, we're just going to buy standard index funds. We're not really going to get into too much more than that in this video. So, and we know that when you gamble, sometimes you can win, sometimes you can lose. When you invest, sometimes you win, sometimes you can lose. And that is why a lot of people think that they're the same or compare them as being something similar. And in that regard, they are, but when you dig a little bit deeper, you find they are very different. Now, I'm going to flip around and show you a historical graph of the S&P 500. So we'll flip around and peek at that. And what we're seeing here is a historical graph going back from 1950 to present day of the S&P 500. And as you can see, there is some up and down movement. We call that variance, but the trajectory is generally moving in the right direction in this type of a fund. And this is a very basic S&P 500. This is a very basic index fund or ETF that somebody might purchase. So although it might go up, it might go down a little, if you hang long term, when we look at historical data, it's always going to be moving in the right direction, always has. No reason to believe it won't always will. Okay? Conversely, we look at gambling. And when you go to a casino, the house is always going to have the edge. So I got a little drawing that I want to share with you. Okay, so now here we have time and we have money represented by the axes. This is your money, okay, and this is your time. Now there's actually one of these is representing the casino and one of these is representing investing in an index fund. All right, now the blue line in the middle is representing your break-even line for your money. Okay, in other words, if you don't do either one of them and you just put your money in a safe somewhere, your money's just going to do this. It's not going to go up, it's not going to go down. Now the first one we're going to look at, I'm sure you can already guess this part, this is going to be the casino one. Okay? And what you're seeing is the green line is representing the actual amount of money you may have. So in this example, we got, so he starts out here, goes up a little bit, goes down, up, down. All right, here we have a big win, goes up, actually is ahead of the money for a little while there, but then comes back down in return, a couple big wins here, a couple big losses. It's kind of a zigzag, but it's following a line, and it's following the red line, okay? And that red line represents the house advantage. So as you can see, it is close to the even line when you walk in. In other words, and when the further you get down here on time, the longer you play, the further it gets from the break-even line. And that's because the longer you play, the more advantage the house has. So the less you play, the less advantage the house has. So the less you get, so if you really want to have the best odds, gamble the least as possible, is kind of the little moral there. But as you can see, there are times when you might go above that line, the break-even line, but the longer you play, as this red line gets further away from the blue line, it gets harder and harder and harder to break even, because that house advantage is just stronger and stronger and stronger the more and more you play any type of game at a casino. Now, conversely, we have this other line right here, and this other little green line, and this is representing the S&P 500 fund that we looked at. So, as you can see, I'm sure you saw that graph went up a little bit, down a little bit. For example, so the green line is my rough drawing of the S&P 500. This might be 2009 when it went down. And as you can see, there were people who could have bought in, and if they were just trying to get in and out of the market, they may have lost money. That's what I'm talking about, short term. If you would have bought here and sold here, well, your money would have gone down on this axis. So if you bought, right before a recession and then sold at the bottom of a recession, yes, you're going to lose money. But in all cases, if you hold on to that money, and this is historically true, if you hold on to that money, it'll eventually turn around and raise back up, and you'll get back your money and then some. This is a historic fact, okay? That's always been true. And that's a big thing I want to point out. Is sure, there's recessions, but people that stay in the market are always going to get their money back. So it's just a matter of time. Time is your friend with long-term investing and with investing in the S&P 500. Time is always going to be your best friend. Now, as you can see, the longer you are in the market, the higher this, so we got the red trajectory here, which shows the longer you're in, the more likely you are to be above that break-even line. Now, early on down here, it might dip below, but way up here, it would take a major crash to go down to that break-even line. Yeah, so basically, the longer you're in the market, the harder it is to go back down to even. And if you start out a little bit of dip here, the longer you stay in, the more likely you are, even if you're down money, the longer you stay in, the more likely you are to get your money back and to then start making money. So the more time you have, the bigger the difference there is between gambling and investing. And this is a big fundamental difference, because as you can see, the similarities are that there's risk in both, and there's variance in both, and you might go down a little bit in both. But the big difference is when you invest, it's almost like you have the house advantage, okay? So another thing I like to think about is you could go out and buy stock in Wynn Resorts, or you can go to Wynn Resorts and gamble. The choice is yours, but if you look at the historic graph, you can either be on this line or you can be on this line. The choice is yours. So I really like to look at things visually, and I think that helps really explain this concept. So another quote I'm just going to leave you with, now that we've kind of looked at this graph and we kind of start to see why they're both a little bit risky, but one is going to set you up for a lot more likelihood of success than the other, is a quote from Warren Buffett where he says, "Gambling is basically a tax on the ignorant." Let that sink in for a minute. Other than that, thanks for tuning into my video. I hope you enjoyed it. I hope maybe if it's a concept you kind of knew, at least it was kind of fun to look at it in a graph. Hopefully it was enlightening. Hopefully maybe next time you're talking to your friend who's telling you that you're crazy for putting a bunch of money in the stock market, you can start to explain some of these concepts to them. Or if you have a skeptical friend of the stock market, go ahead and send them a link to this video, because I really hope that it would help educate people and help teach people why they should be interested in investing. So other than that, if you enjoyed the video, feel free to give me a like. Feel free to hit the subscribe button. I'm going to try to keep more videos coming out on a regular basis. That is today's video. Thanks for tuning in to Financial Success.